Welcome to our session. My name is Dr. C. Adam Callery, and I am so happy to be here today. We will accomplish our goal today by focusing on 4 key areas. We want to understand the investment cycle. We want to introduce accounting fundamentals. We want to discuss the differences between the accounting statements and using financial reports to improve decision making. We also have 3 learning objectives. They are to reduce the level of anxiety that accompanies interpreting financial statements. We want to clarify the difference between the various financial reports, and we want to explain how to use financial information to support business decision making. Let's stop for a minute and take a step back. For the past 12 years, I've had the opportunity to talk with numerous business owners. In many cases, these business owners have not taken the time to look at their financial statements or to analyze their financial statements. Instead, what has happened is that they've essentially outsourced them to an accountant or to a bookkeeper. When that happens, they lose connectivity with the numbers. They lose an understanding of the business. What we want to do today is to reconnect, bring you back, and give you the opportunity to learn how to look at these very, very important documents so that you can manage your business in a more efficient and effective manner, but also help you to improve your decision making. One other thing we want to say about this is that it will help to improve accountability. Financial records, by their nature, paint a picture of the overall health of your company by looking at your financial record. They help the owner discern what actions and management decisions to make. How do these reports do that? As you watch your numbers each month, each quarter, each year, you get to see a pattern. That pattern will help you to understand whether or not the decisions you're making are moving in the right direction. For instance, revenues. Are revenues increasing? Are they climbing steadily? Or are they starting to flatten out or decline over a series of periods? Same thing with expenses. Are expenses rising? And typically that happens when a business starts to grow. But the question is, are they rising too fast and eventually can hurt your profitability? Encouraging accountability also helps to include your employees. You want your employees to know that you're monitoring what's going on with the business so that it will create a culture where they also will start to monitor operations and help you maintain your costs and also hopefully maintain solid profitability. So let's begin. Understanding the investment cycle. First, understanding the investment cycle means that you understand that the investment cycle is at the heart of any business. Investments fund purchases. They enable the work to be performed in any business. And they establish the business in the marketplace as well as in the eye of the shareholders and the stakeholders. Who are stakeholders? Stakeholders in this case are your creditors, your investors, your employees, the government, as well as the community. We start off with the core investment. Every startup has this. A couple of $1,000s here, maybe $10,000, maybe $20,000 to get the business up and running. That's the core investment. That core investment is then used to do what? To make some strategic purchases, maybe of equipment, maybe of supplies, maybe even bringing in your first hires. They essentially establish the business. They create what accountants call the stored value. Once we have stored value, once we have the equipment, once we have the people in place, once we have a place to operate like a retail store, we then start to consume that value by using those resources. And ultimately, we're using those resources to do what? To create our goods or the services that we're going to deliver to our critical clients, our critical customers. And then the cycle begins again. The business will require additional investment. So it's no longer core at that point. It becomes additional investment that we must make to keep the business solid, to keep it performing, and to keep it moving forward. Ultimately, financial records are public documents. Not public in a sense that we're going to release your public information to the general population, but they're public in a sense that eventually you do have to share them. You have to share them with your partner, in this case your business partner. You may also have to share them with bankers. You may also have to share them with investors, because ultimately these critical individuals want to know that the business is viable and also is sustainable. Let's continue having our discussion around this investment cycle. There's two parts to it. One is what we call short-term business investment. That includes hiring your employees, buying critical technology, maybe mobile phones, maybe just a desktop computer, laptop computer. Inventory, if you run a retail store, bringing in clothing, bringing in appliances, whatever your retail store sells. It means managing accounts receivable. For those who are not familiar with accounts receivable, it means that I've made a sale, but I provided credit to the buyer. The buyer ultimately has not paid me yet, so maybe I'm giving them 30 days, 45 days to pay me. Well, while I'm waiting for that money to come in, I do need resources, in this case financial resources, to pay my immediate bills. Last but not least, we have the cash that sits in the bank. All of these represent what we call short-term investment. Short-term in business means we're going to spend this money in a period of time less than 12 months. So these are the monies we'll spend in January, February, March, April, May, throughout the year in order to do what? Keep the business moving forward. We also know we have what we call additional long-term investments. These long-term investments will include furnitures and fixtures, equipment and tools, buildings and vehicles. So let's say we're running a catering business. We may need trucks to help us move our catered items from our kitchen to maybe a wedding. So those vehicles become what we call long-term investments. By definition, accountants tell us that long-term investments are investments that we're going to use for a period of time greater than 12 months. And that should make a lot of sense to you. If I buy a refrigerator, if I buy a stove, and I'm running a restaurant, I do not intend on replacing those items within 12 months. It wouldn't make any sense. I want those items to work for at least 1, 2, 3, 4, 5 years, so I can essentially get a return on the investment that I'm making in these items. So accountants are aware of that. They essentially take those investments, they split them into two categories, as I mentioned. One, a short-term category. These are items that we're going to use throughout the year. And then a long-term category. These are items that we will use over a longer period of time. Of course, those of you who already run a business know that besides these investments that I'm talking about, money that we're putting into the business, money that's going to be sitting there creating this stored value that I talked about, we also have daily expenses we have to make. Maybe it's bookkeeping expenses, accounting expenses, advertising expenses, all those favorite bank service charges that we have to pay. Maybe legal and attorney fees. Those of you who are general contractors, maybe you have to have someone help you prepare contracts. So therefore you'll go and hire an attorney to help you to prepare these contracts that will essentially indicate how much you're going to get paid on a particular job, also to indicate when that job is going to be completed. So you want to make sure that contract is accurate because it's going to be governing how you run your company. Licensing fees, merchant account fees, office supplies. Those of you who run a legal firm or maybe an accounting firm, you're going to have to buy supplies, paper, pen, those sorts of things, even toner cartridges for your copiers. Online services, all of us rely on the online community now. The internet is vital to most businesses. We have to run a website, we have to have an email system up and running, we have to run social media, so all of those things cost money. For those of you who are a little bit more advanced, have a little bit more time in, maybe you have what we call coaching fees. You actually sit down with a consultant, maybe every 3 months, and you talk about your business, you talk about the strategy that you're planning, and that person serves as a sounding board for you, a person that will sort of give you some feedback to help you run your business a little bit more efficiently. Telecommunication fees, depreciation and amortization. Well, what does that mean? For those of you who've never had accounting before, think about the car that you have. As soon as you buy a car and you drive it off the lot, everyone says it loses value. That's depreciation. So if we think back to the long-term investments that you're making in equipment and computers, eventually those items will depreciate every day that you use them. So there will come a time when you're going to have to replace those items. And depreciation is a way of estimating what the cost is going to be to replace those items. Insurance expense. You cannot have enough insurance. You know, we know about life insurance, we know about medical insurance, especially medical insurance for our employees. But you should also be prepared to have insurance costs as it relates to protecting your business, protecting your inventory. So you may have to have a policy for that in case of a flood or fire. Printing and duplication, again, for those companies that are involved in the services, maybe those who are medical professionals who are providing medical services such as mental health services, or maybe if you're running a clinic, there will be times when you have to, document services that you're giving to your customers or to your clients, and that documentation has to be stored somewhere. So you're going to have to make copies, keep them in a file cabinet. So you will incur some copying or printing costs. And last but not least, you have to pay your taxes, both federal, municipal taxes, as well, of course, as state taxes. So you have to estimate these things and be prepared to have those costs in your mind and budgeted in order to run the business forward. So let's stop for a second. We've talked about all of these expenses. We've talked about the investments. Why do we do this? Why do we need to think about these? Because the reports that we're going to talk about today are the reports that help you to catalog or capture the amount of money that you're spending, the amount of money that you're bringing in, the amount of money that you're storing up in that stored value. You need to know where you stand, and you need to know where you stand financially if you're going to be successful long term. All right, so let's think about what the accountants have done for us to make it a little bit easier. What we know is that there are many businesses out there, catering businesses, hair salons, restaurants, manufacturing companies. We've already talked about those who are providing mental health services, daycare, all sorts of businesses. So in many cases, people just say, especially when they're in the startup mode, they go, well, there's no way I can track all of this. So all I need to do is just look at my bank account. As long as there's money in that bank account, I'm going to be okay. What we want to do is we want you to move away from that practice and realize that there is a way to manage your business independent of what the business is. And what you need to think about is how accountants think about it. So what accountants have done is that they've separated businesses into three categories. One, services. The second one, retail. The third one, manufacturing. And we call these business types. So I'll say that again. Services, retail, manufacturing. All three of these represent specific business types. Sometimes you'll hear people use the phrase, a business model. When they use that phrase, they're literally saying, how do you earn revenue? What have you set up in order to earn revenue consistently? We call that the business model. Accountants call it the business type. So what that means is this. Each business type has certain activities that occur that are unique to that business type. At the same time, they also have some activities that are universal that we find in all business types. So let's start with that first. So we know in a business, I need to eventually collect money. So how do I go about doing that? In some businesses, I need to write an invoice, or I need to prepare an invoice. Well, that occurs in some service businesses, such as mental health services, medical services, catering services. I end up sending an invoice to my client, and I await payment. Well, in a retail business, typically I don't have to have an invoice, but I may end up receiving an invoice from those who provide me inventory. So therefore, I get used to seeing these documents come my way. They'll have on there information telling me what I purchased, when I purchased it, and how much it cost me. So these are records that I can put into my file so I know what my costs are. In manufacturing, same thing. They'll have invoices as well. So let's say I'm General Motors. I produce a number of cars. I then ship those cars to a car dealership. And then I will send that car dealership an invoice for those cars that I ship to them. That way I can recover my costs as a manufacturer. So invoicing is a common practice that we find in all three business types. But now, what are some of the unique activities that we see in the business types? Let's start with services. So let's use a restaurant as an example. In a restaurant, typically, I need to lease a space. So I got to rent a space for me to host the restaurant. Next, I need to buy tables for people to be able to sit down. I need to buy chairs. So I start to buy these things that are going to support what we'd like to call the infrastructure of a restaurant. Tables, chairs, fixtures, lighting. I need to think about the food. Whatever I'm going to be cooking, I need to bring in the food ingredients. So that's my inventory in a restaurant, the raw food that I bring in that needs to be prepared. I'm going to have to buy appliances, refrigerators, stoves, countertops. So I have to have these items for preparing the meals to be cooked. I need to be able to cook the meals, and by the way, I need to be able to package them and get them to my customers. So that is a typical restaurant operation, and you see that in most restaurants. So if I was looking at the records for a restaurant, I would expect to see those activities in those numbers. Purchasing of food inventory, purchasing of infrastructure items, purchasing of different items like supplies, straws, cups, so on. Retail. When I think about retail, I think about Target, because we've all seen a Target before. When I walk through the door, what do I see? I see cash registers. I see shelving units. I see clothing on racks. In another corner, I see appliances. Target has to lease the space. Number two, they have to purchase inventory, which can be clothing, appliances, hardware goods, pharmacy goods, and electronics. They have to purchase the shelving units that the items are going to sit on. They also have to reserve some warehouse space because they can't put everything out on the floor. They have to keep something in the back. So once those items clear off the shelves, they can go to the warehouse and bring those items forward. And of course, they have to hire staff. So these are the unique activities that take place within a retailer. Purchasing of inventory, purchasing items that are going to be part of their infrastructure so they can display that inventory. They're going to have to hire staff. They're going to have space, a space for actually showcasing what they need to sell, and space for storing what they have available to sell. A typical retailer. So again, when I look at their financial records, there's certain things I'm going to be looking for there that represent some of those items I described. Last but not least, manufacturer. Much more complicated, a lot more activities happening here. So when I think about a manufacturing business, what is happening there? They're taking some resources, they're converting them, and then they're making what we call a finished product. So we'll use a car as an example. I'm taking all these spare parts, those are the raw materials. Somehow by magic, they pass through a building, and I have all these people inside, and they connect all those parts together. And on the back side of this building, or on the warehouse side of the building, out comes a perfect car. So we call that conversion in the middle. So manufacturers take these raw materials, they convert them, and they make what we call a finished item. So when I look at their records, what am I going to see? They're going to have to purchase raw material. They're also going to have to lease space or buy space. They're going to have to purchase equipment. That equipment is going to be used to start to create or form that car. They're going to have to purchase office furniture because they're going to have people working in there, maybe as staff or administrators who are part of this operation. They're going to have to hire, in this case, union employees to actually build the cars. They're going to have to pay for shipping because the cars have to leave the manufacturing location and be shipped to the car dealership. And then, of course, they're going to hire staff. So as you can see, there's going to be a lot more activities taking place in manufacturing. So if I'm looking at their financial records, I'm expecting to see a lot more detail there as compared to a service company. What's the conclusion here? The financial records will ultimately tell me what I'm spending, what's coming in terms of revenue, also giving me a sense of what I'm spending in order to operate this business. Also, it's helping me understand where I'm spending my money And am I spending my money appropriately for the business type that I am? Whether I'm a service business, a retailer, or a manufacturer. And this is the core, this is the key to understanding why we're having this discussion with you today, is to move you from handing over that important information to your accountant and then having your accountant just send it to the IRS and not look at it. We want you to begin to look at it, to understand what's sitting before you, to understand what these numbers mean, and to make sure that the numbers that you see are appropriate for the type of business that you do.